Hello, everybody, and welcome to our IIF COP Talk on financing sustainable transportation. I'm Sonia Gibbs, Managing Director, Head of Sustainable Finance at the IIF, and thank you so much for joining us today. You know, this discussion today could not be more timely, today being the last day of COP27 in Egypt, and certainly the urgency of building and financing sustainable transportation systems around the world is a major cross-cutting topic in Sharm el-Sheikh in Egypt. So President Biden's speech at COP really highlighted the need for support for clean transportation in the Inflation Reduction Act, the IRA, including zero emissions vehicles, sustainable aviation fuel, the whole gamut of sustainable transportation initiatives. And he noted that the IRA would reduce U.S. emissions across the board by something like 1 billion tons by 2030 and spark a whole cycle of innovation to reduce the cost and improve the performance of clean energy technology. There's really no way to reach international climate goals without greening the transportation sector, which accounts for over 25% of all global emissions. So looking across industries, aviation, rail, shipping, commercial and passenger vehicles, we urgently need financing solutions. So our excellent panelists today will shed light on all these topics. And to get us started, let me welcome Amy Ban, who's Head of Supply and Ecosystem for Expansive. Amy, we're going to start off with a fireside chat, and thanks very much for joining us today.
So great to be here, Sonia. Thank you.
So when you think about the transportation sector, one of the most greenhouse gas intensive sectors that there is, and one of the hardest to abate, maybe can you explain to us a bit why this is so and what kinds of initiatives are out there to reduce emissions in the transportation sector?
Happy to. And you're right, it is a hard to abate sector. There's so much innovation, though, and so many promising initiatives happening. So I think that's worth noting. But I would sort of summarize it as there are a couple of different constraints they're facing: supply, costs, technology limitations, and then whole-scale infrastructure change. So I'll give you a few examples of those. On ground transport, we're seeing electrification. It's happening. It's starting to accelerate. But you have to scale up those systems to support it. So things like battery technology are moving at a very rapid pace, and they'll continue to innovate. It's really promising what's going on in that space. Charging stations, you're starting to see that more and more when you're traveling around and at different places, but there's a lot more to do. And lots of companies are cropping up to innovate in that area as well. And then costs. So there's still a premium on the vehicles, but that's going to come down over time as well. And policy plays a role there. So all those things contribute into how quickly this can scale up and transition. But in sectors like aviation and shipping, they do need to look at fuels because there isn't the technology available necessarily at this point in time to electrify those vehicles. So the challenge with that is the fuels make a huge difference. Sustainable aviation fuels, for example, can bring the emissions down up to 80%. That range is typically 50 to 80% lower, but it's still not at zero. And so they're still working to offset as a gap filling component to that. That's where my company Expansive comes in and has supported aviation with an offset program called ACE and under the Corsia program. So that these just aren't overnight shifts. Changing the infrastructure takes a long time. So I think looking at all those different levers is really important. Aviation really is a super example of a strategy that they're implementing very well on track. They're working to change their products, change their operations and make them more efficient, change their fuels, and then in the meantime have that transition gap filling component of the offsets.
Well, so you mentioned, that sustainable aviation fuel can make a big difference, reduce a lot, but not all of emissions in the industry. Before we turn to carbon offsetting, can you give us a sense of how far along the shift to sustainable fuel is? I mean, do all major airlines use it extensively now, or are we still not there yet?
Well, it's a supply challenge. There is really no limit on the technology for those. There's any number of feedstocks that can feed into creating SAF, and there's also the technology processing to do it. It's really a matter at this point of getting that cost delta down and scaling up those facilities. And these are long-term capital projects, but there's several companies doing very, very well in the space, and they've gotten the attention. People see the value and the importance of it. Lanza, for example, Sky Energy, they're very, very promising. It's just going to take years. So we're still in that 1 to 3% replacement range, but over time, you'll see that hockey stick curve that we have in the past with other types of renewable energy where it'll shoot up. I think all of us are very optimistic that's going to occur. It's just not an overnight transition.
Yeah, indeed. And maybe when we get to our panel discussion, we'll talk a little bit about how these are being financed, these developments. But let's go back to carbon offsetting. and this whole development of voluntary carbon markets around the world. How can these hard to abate industries successfully and credibly use carbon offsets to and for example, initiatives like the Integrity Council for the Voluntary Carbon Market, how can all of this help? It's a tough area, offsetting.
It's a great question, Sonia, because there's so much critique on this area right now. People want to know, is this meaningful? Is it legitimate? And so I'm glad that you brought that up. Offsets really should be used in a way that's supplement to your overall climate strategy. It should be nested into that broader ESG piece, and your products and services should be your primary focus, right? You should be looking at how do you bring down your direct emissions first in your scope 1 and 2. But offsets really do present a great opportunity to take action now. They're, supporting projects. In many cases, it's the only source of funding for a lot of these projects around the world that are resulting in real-time emission reductions or avoidance. So it does play a very important role. I think that's really key to note. And a lot of them are looking at it as a transition. I think a lot of the companies are relying on the guidance coming out. So for example, the BCMI, the SBTI, we won't get into the details of all the acronym soup out there, but they're getting more clarity around how they then translate that into their corporate accounting and fit it into their broader strategy. I will say, in our Expansive as the leading carbon platform, we have about over a third of the market's credits flowing through our system in the past year. And even despite the volatility and the geopolitics and the inflation this past year, we're seeing sustained demand. I mean, this is still a very robust space. And we have launched benchmark contracts where we've pegged standardized contracts they can buy that's much more efficient and a way to buy in bulk high quality integrity credits. What we do is we peg those to global standards, such as CORSIA, that came out of the aviation space. And we're seeing very rapid rise in the percent of which those are part of the overall market. So buyers are really becoming more sophisticated, looking at how to use this in a long-term way as part of their strategy, and it's going quite well. And you mentioned the Integrity Council. I was really pleased, Sonia, you and I met actually, I think, in the initial task force that kicked that work statement off. We're very supportive. We're very optimistic. From the Expansive side, we are excited to partner and help implement it once it's operational and the new standard comes out and program starts to approve different credits. We think that's going to be really, really helpful. Global frameworks bring that clarity that buyers really want. They want to be able to have the confidence and the assurance that if they buy something going forward, it's got that legitimate stamp of approval. So we'll be watching that very closely. I think lots of stakeholders will. We're looking forward to the work, and I know the team. I know they're working very, very hard to get it right, and it's not easy, to work with thousands of stakeholders around the world and try to make everybody happy. It's a challenge, but I think that they are, charting this course, and it's going to be well received once it's released.
Well, it is very interesting to see so many initiatives in the voluntary carbon space springing up all over the world. And, firms like yours are helping to connect those dots as well as the voluntary side of markets builds out. And then, of course, you have the whole compliance carbon markets already existing, emissions trading schemes and so on. So, looking ahead, you're probably going to see some interoperable standards develop between them so you can really grow this market.
Yeah, that's, I think one of the more interesting things happening right now is, post-Paris Agreement, post-Glasgow, we are seeing the emergence of the government starting to implement Article 6, which in COP and UN speak is, that jurisdictional piece where governments are tracking their own targets and goals and how their credits and projects feed into that system. And there's a whole lot happening to build that infrastructure up behind the scenes right now. It's pretty exciting. So our company, APX, is our portfolio company that powers a lot of the major carbon registries and renewable energy side too. We have built that. So we have an offering where governments can have their registry or a regional one and then integrate it with those other systems. And so I think you're right. Increasingly, we'll see the interplay between the compliance and the voluntary side. And companies are going to be looking as well for, really robust data infrastructure and a way to have that digital tracking and have it integrate all together. That's kind of the next phase of this, right? Is to make sure that everything is accurate, cohesive, and having it together. So we're really pleased to be able to be powering that and building that software infrastructure. And I think there's a whole lot more to come. I think what we saw coming out of COP this year is this move towards action, right? There was a lot of pathfinding and negotiations these past several years. And now you see everyone focused on what do we do? How do we create blended finance structures? It's this rising tide. And I'm really optimistic about that. And I think that we have the tools to do it.
Well, as you say, there's a lot going on at COP. It's been often referred to as the implementation COP, where everybody made promises in Glasgow at COP26. And now these are meant to see the way forward on how they'll get to fruition, coming from Egypt and then next year in UAE for COP28. But maybe let's stay with COP for a minute. You mentioned Article 6 and the Paris Agreement goals. And the work toward these nationally determined contributions, what each country in the world is doing to advance these goals, it covers all sectors, including transportation. And, when you think about things like voluntary and carbon markets and integrating accounting across all these systems. So what's happening with this infrastructure to support transition?
Yeah, that's what I mentioned. So we have got registry systems and platforms that integrate that all together with APIs, software ways of connecting in real time. But the way it actually works is kind of similar to the voluntary side. Project developers can get their projects issued and approved by registries or standards. We then post them into the system, and you can tag by attribute. So there will be drop down where you can actually say, okay, it's this jurisdiction, it's this type of credit. It's, you can capture all of those different pieces and criteria so that then buyers have that digital record, kind of a digital passport that follows it throughout its life cycle, all the way through retirement. And so having that all in one place where it is accessible and the data is very transparent, I think will be pretty critical, because there's a lot of questions that have been raised around how does the voluntary buyer know if that credit might end up, having relevance in the jurisdictional market? How do the countries track all of that? And so we're building those systems to make sure that that's all, again, fully tracked and transparent going forward.
No, absolutely. And that kind of transparency in pricing is critical, right? Because we don't have a global carbon price. There's not a clear path to any kind of global carbon price. So the way that carbon markets develop is going to be instrumental in figuring out how we price and have price transparency around carbon and natural resources like water or bio-based fuels, hydrogen. And so maybe this kind of brings us around to what you're doing at Expansive. You had this digital funds program last year. So tell us about this.
Yeah, and I think this has changed tremendously in the past 2 years. Pricing around carbon and other environmental commodities has just matured much more like a market in other type of industries. So if you look at our homepage at Expansive, you'll see different daily price reporting on carbon, on renewable energy. We also have water, and we have our fuels program. And so that's showing you in real time what is happening in the market. That's a big change from a couple of years ago where there's all this sense that it's opaque or you can't get that information. And so I would encourage anyone to check it out. And because we have the benchmark contracts, S&P Commodity Insights, also known as Platts, as a PRA, they publish that pricing, which provides critically important price discovery for those buyers looking to figure out how to price things and benchmark it and build it into contracts. Let me share an example. So we have a nature-based benchmark contract called the NGO, which has been leading in the price point. If you look at these graphs, it's amazing to see the whole market kind of follow along. But just last week, we had blue carbon mangrove forests trade for the first time, and it traded at $29 a ton, which was almost 5 times the nature-based benchmark contract, which is very interesting because that gives buyers, a way to mark and say, okay, this is what this is being valued at right now. And then that all goes into that general price reporting. And so it's really a sea change in how this was working a few years ago. And I'll mention too, you asked about the fuels business. We're also innovating to move it upstream. So offsets are, a critical part of funding in this space, but scope 1 and scope 2 reporting as well is of strong interest to companies. And so we're working on how do we embed it upfront in those assets so that companies can differentiate, among their assets, what the environmental attributes are. So for example, we have a methane intensity program where companies can actually measure through on-ground, real-time sort of facility level. And then over time, we'll be able to add in satellite layering and all of that. And so it's really, again, a sea change in how this is working. And that will follow those assets through their life cycle. And so companies, even if they transact and it's bought or sold, they'll be able to still track those environmental attributes.
Well, as you say, this market development is absolutely fascinating. And as you get better pricing and price transparency and ultimately higher prices, which is a goal for a lot of these natural resources, it gives suppliers an incentive as well to produce more, so sort of grow this market. Man, I wish we had more time to continue the conversation, but this has really given us a wonderful insight into how these markets are developing and developments at COP as well. So Amy, thank you so much for taking the time to be with us.
My pleasure. Thank you.
So let me go ahead and turn to our panel here, and it gives me great pleasure to introduce Matt Boris, who is Treasurer and Head of Capital Markets for Atlas Corporation, and Liz Cabot, who's Head of Transportation and Logistics Investment for Wells Fargo, and Detlev Moore, Senior Partner, McKinsey & Company. Welcome, everybody. It's great to see you. Thanks for joining our panel here. So we've heard some scene setting from Amy. And Detlev, I want to start with you here, just to give us some big picture. You've done a really great report on this topic. And, you know, we're going to need something like $2 trillion of transportation infrastructure investment from now through 2040 to support sustainable economic development. So tell us, you know, in your research, what do you see as the best approaches to financing these very costly projects, and how can they help with productivity and reducing emissions and even things like limiting social exclusion? How can sustainable transportation help?
Yeah, obviously we are talking huge numbers here, almost mind-boggling, which have to be taken for the next couple of years. And if you think about it, this is not just one way to finance this, but we will be needing all sources of finance, public, private, and any mix of it, traditional instruments, but also new instruments that have to come to bear to really do this heavy lifting on the infrastructure that has to be created. What will be very critical is to have a helpful framework, helpful conditions, because there are many moving pieces still in the equation. You have risks, the traditional project risks, which might have to do with countries, which have to do with large infrastructure projects per se. But there is also that new industries have to be created. You have to be sure that the uptake is there once you have the project finished, that you have the supplies that you might need or dependencies. So extremely complex. And I think everything that helps in order to make these risks more calculable and makes it possible to handle them will be helpful. On the other hand, I think we have to see that there's a huge chance built into this, because we are and have to build industries basically from scratch for new sustainable fuels, for example, or we have to build charging infrastructures. And building these infrastructures in a thoughtful and sustainable way right from the beginning, I think is an immense opportunity for all of us. And there will be also the need to really reflect on what are the best practices from projects, from large projects specifically, that we can reflect here to avoid the typical overruns, the typical delays that we see in many projects. Because experience shows there is a 20-30% plus opportunity to improve projects if you run them well versus you do it, let's say, with the average performance.
Well, Liz, you know, Detlef's brought up a lot of really interesting considerations for this type of investment. The scale of it's huge, so we have to scale it. The risks are significant in this type of project. There's project-specific risks that you have to find ways around. And then he's spoken about best practices in these types of projects. So given this, you know, this gigantic scale of capital, governments can't do this on their own. So what role can public-private partnerships play?
Yeah, I think that's a great question, Sonia. And we've been spending a lot of time on this. Obviously at Wells, we're always looking for ways to support our customers. And one of the most important topics for our customers today really is how do we do this transition to a secure, resilient, and equitable low carbon economy. And so we've been incredibly focused on all of the different alternatives and types of financing. And I think we'll get into some of those a little bit later in the discussion. But, you know, obviously governments have a tremendous access to capital. Where they struggle a little bit is on delivering projects, you know, quickly and effectively. And so how can private public partnerships really be successful at bringing to bear a lot of the, again, the infrastructure that's going to be required around some of these sustainable projects, some of just the investment that's going to be needed in equipment. We've been working really closely with a lot of municipalities on, charging stations. And if you think about municipal buses, school buses, how to start implementing some of that. And we will finance that both through the equipment, but then also the infrastructure, realizing that that's a really important component of it. We've also been involved, if you look at our municipal finance team, just in terms of, helping, whether it's ports or whether it's cities, understand how to roll out some of this sustainable transportation. So it's a really good question. I mean, we're going to, I think, continue to see a lot of investment, both by debt investors, by banks in partnership with their customers, and then by equity investors as well, as they continue to look for ways to support, I think, this transition to sustainable transportation that is obviously very much underway.
Yeah, it's interesting. You mentioned the different types of financing structures and capital stacks, and we'll come back to some of those questions. But could I just follow up on one issue you mentioned, which is absolutely fascinating? Amy brought it up as well, and that's this issue of charging stations. I mean, I think there's the general perception that there's a lot to do there with getting those up and running, and maybe the scale of putting those everywhere they need to be. That's a big financing challenge right there. Yeah.
Yeah, I think that's exactly right. And then it's a question of at what level does it happen? And I know that obviously the Inflation Reduction Act, I think, is going to be really helpful in driving a lot of that change, but it really does happen at the city level and the municipality level. So how can we partner with them to help implement some of that? And then I think another comment that Amy made earlier on is just, this is not the final stage technology. I think there's a lot of technology improvement that's still going to happen. And so how do you think about, what's, if it's, battery power technology today, but at some point in time, it's hydrogen, fuel cell technology. And how do we make sure that we have, the right level of investment, but then are also taking into account some of the technological changes that are going to happen, because it's very much underway. I think there's, changes almost on a daily basis, it seems like, in terms of where the technology will get to. And so how do you think about the infrastructure, but also think about future infrastructure and what will be required there? So that's something that we're working really closely with our customers on, and trying to help them understand, things like residual value risk and how to, really finance some of these things for the long term, especially when we know they're transitionary in nature.
Well, it's kind of two big pieces of the puzzle, right? So banks like Wells Fargo are going to be financing not only the infrastructure per se, but finding ways to finance these sometimes very risky new technologies, because, if you finance 10 of them, I guess maybe one might pan out. So it's a big challenge. Yeah.
Yeah, agreed. So I think, again, just trying to figure out, not just financing the vehicles, but making sure that these vehicles, can be, in operation for a while, because the infrastructure, again, exists to allow them to be.
Yeah, exactly. Well, Matt, let's bring you into the conversation here and tell us a little bit about decarbonization in the shipping industry. And you hear, it's maybe underappreciated that it's such a huge industry, shipping, and emissions are significant. And C-SPAN, has almost, 4 billion in sustainability linked and green financing. So this is a big step for you at Atlas in aligning your balance sheet with long-term decarbonization goals, as we're all trying to do. So maybe tell us about these sustainability linked loans and how they can help in reaching net zero goals.
Yeah, definitely. And maybe first off, to set the stage, shipping is responsible for about 90% of global trade by value. And where we fall in this is our largest portfolio company, C-SPAN. We think of ourselves as a pipeline for the sea. We own the pipelines. Our customers are responsible for what flows through. So we're the largest owner and lessor of container ships, and lease them out to the major liners of the world. And so the decarbonization challenge for the shipping industry has been, as Liz pointed out, you're making very long life asset decisions and very high CapEx decisions. Ships live for 25 to 30 plus years. So you really have to have certainty or confidence when you make those investment decisions that it's technology that will last the lifetime. And I think that's where, we're a bit luckier than some other industries in that we have the IMO, the International Maritime Organization, that sits above shipping and is able to set targets that are aligned for all participants. So regions and governments might set regional targets, but we've got at least an organization that aligns us all together. So we're all kind of moving in the same direction or with the same incentives. So that has been helpful. But it is still a major CapEx spend, and the technology to transition shipping to carbon neutral doesn't exist yet. We've got biofuels in the near term, good transition solutions like LNG, which can be made increasingly efficient long term. And then there's the final goals of carbon neutrals like ammonia and methanol. But like Detlef and Liz were touching on, there's significant global infrastructure that will need to be built out to support that. So that's 10, 15 plus years out for the industry. And transition for our industry will take, I've heard estimates of about $2 trillion to carbon neutral by 2050. So it's a significant effort. And I think green financing and sustainability linked financing allows us to highlight some of the positive and transition elements without having that final solution in hand. So we've been pretty focused on ESG and making it a central pillar for us for some time. And when we started to learn about sustainability linked financings and green financing, we wanted to get involved, do it the right way. And so we made a decision pretty early on that we'd pursue it. And we pretty quickly became a leader in the space with, as you mentioned, about $4 billion in green and sustainability linked financing to date. Where that's been really helpful is on the sustainability linked piece, we're able to set KPIs that are that allow us to do interesting things with other industry participants.
Maybe just unpack that a bit for our audience, this notion of KPIs or key performance indicators. How does this actually work with this loan? You promise to do X, Y, and Z, and you get a lower cost of financing?
Yeah, for sure. So you'll set up targets or KPIs, and you'll work typically with a second party opinion provider to kind of verify, validate the relevance and significance of that target and how you'll measure it. And there's a lot of creativity allowed in that process. So you don't just have to say, we're going to be carbon neutral with our investment. You can do things like we've aligned it so that if we create charters or leases with our customers that reward them, or there's a pay and gain share for their performance with our assets, we're rewarded for the creation of that and execution. We're also linked to the emissions of our vessels. So if our emissions are above or below a benchmark target, we're rewarded or penalized. And that, while the pay and gain share may not be meaningful in total quantum relative to our business, it does force our businesses and our industry to focus on these metrics and these improvements. And it really does make a difference as we've seen.
Well, it's a fascinating market segment, this whole sustainability linked debt instruments, including loans. And we run a sustainable debt monitor quarterly here at the IIF, and sustainability linked loans in particular are one of the fastest growing pieces of the market. So thanks for illustrating how this works in real life. But Detlef, let me come back to you here. I mean, we've been talking about what the financial sector can do, which is fantastic, right? That private markets do amazing things and full speed ahead. But governments have an important role as well in helping to, in particular in something like infrastructure. So to move sustainable transportation forward, you really need governments to play a role. So tell us about what kind of policies would best place incentivizing decarbonization across this industry.
Yeah, as we discussed, and Matt and Liz also mentioned, we are talking in most of the cases about real long-term investments. So, for example, the ship's 30 years. And just to make it more specific, if you today decide you want to go for a new technology with ammonia fuel, for example, then you need to order a ship. It takes 3 years, and then you want to run it 30 years. So you are basically beyond 2050, when the lifetime of this asset will be paid off. So you need specifically a framework that provides security, some stability around the boundary conditions in which you are operating. And it's also more helpful probably if governments agree on outcomes and leave flexibility for the way how to reach certain targets, because that opens a greater space for innovation and new technologies, and probably leads to a more efficient situation. I think the big issue is, of course, specifically if you talk about a global industry, that it would be a huge value for all the players if we were equal level global playing grounds. Mm. That would allow you, independent of where you operate under the same framework. For example, the same cost for carbon, the same requirements that you do, because then you can purely focus on how to reach these targets and how to get things done. If you have to work with different frameworks, if you have different competitive situations, things get more complicated. I think that is something easier said than done, where governments can obviously help a lot.
I was going to say, you know, I think probably listening to what you're saying, we don't have this kind of level playing field, and it is quite different in different jurisdictions. You in Europe, of course, are quite far ahead of many other areas.
Yeah, that's a problem. That's in a way a problem. On the other hand, some regions will have to move first in order to get the train going. And I think we have seen, for example, in the automotive industry, that Europe moving fast, also China moving forward with battery electric vehicles, basically is unlocking the innovation, is unlocking the transition of the industry, and then other regions are following. And I think it's critical you get the critical mass together to get this momentum started.
Yeah, and it is at a time when, of course, international cooperation is very challenging for a number of reasons. So, you know, Liz, maybe bringing it to the current situation that we find ourselves in now, a lot of changes in the transportation industry just this year, you know, given the energy crisis and very high inflation. Has this kind of changed the picture in the move toward adopting greener transportation models? And, you know, where are the challenges that we face in really making this shift happen?
Yeah, it's a great question. You know, it's interesting because obviously this year has certainly, like you said, been a challenging one. We've seen higher energy prices, we've seen supply chain shortages. So just, you know, things are moving slower than they would otherwise. I think it's been a challenge with getting capacity and getting new equipment. I think Det talked a little bit about just the time lag on new equipment once you order it to when it's actually available. But I think also with the inflationary backdrop, and then with, again, higher energy prices, I think people are starting to better understand the cost benefits of having more sustainable transportation equipment in their overall fleets. I think it's going to be something that we see, you know, continuing to unwind, because at the end of the day, it does have to make economic sense, as well as, you know, overall just ESG benefits in terms of people really incorporating some of that equipment in the long term and making the investments that are needed on the infrastructure side. So I think it's been exciting to see just some of the changes that are happening. And I think we're expecting that to continue to roll forward at a rapid pace. Obviously, you know, the just overall economic outlook always creates a little bit of a challenging backdrop for that. But I think in some cases just solidifies, you know, a lot of of our customers and their commitment to the ESG side of things. Maybe one other point, I thought your conversation with debt was pretty interesting too. I mean, if you look at ESG, and this is capital markets related ESG issuances, in the US, it's about 6% of total investment grade volume. In Europe, it's about 39% of total investment grade volume. So I think we just have a lot of room to still go. And I think there's a lot of demand from both equity and debt investors in helping to really fuel this transition. But again, it needs to, be in a sustainable way and one that makes, economic sense, and that companies can really understand how to finance that and how to finance that change effectively and efficiently.
Well, it's a really good point you make about the very modest share of ESG issuance, particularly in the US relative to Europe, and even more so when you think about emerging markets, right, where debt markets overall are still evolving. It's very challenging to increase the share of ESG issuance in those markets as well. So an important point. And Matt, just kind of building off the comments Liz made, going back to this question of inflation and higher energy prices, maybe tell us about how those are impacting the shipping industry. Does it drive more greener practices and so on? How do you see it?
Yeah, I think broadly, like inflation and the demand we've been seeing, the massive demand growth for international ship goods has brought about a push for quicker change. I think there was uncertainty around future technology, and because of that, people were delaying investment decisions until certainty was provided, which may never happen or may be far away. But the demand and inflation and the environment we're in pushed significant investment into new vessels that were either conventionally fueled, much more efficient than existing vessels, and future fuel ready, built to be future fuel ready, or they were investments into LNG, which we see a decent long-term transition future in. So I think that's where the biggest impacts have been. And to Liz's point, when times are good, you do see more flexibility and more capital, more focus on doing these additive elements to improve the sustainability of the industry, which are more difficult when you're in kind of belt tightening time.
That's fascinating, and you mentioned this term future fuel ready, and I'm trying to imagine, like a great big ship that runs on conventional fuel. So you're saying you can build in a system that would allow you to use a different type of, low emission fuel in future. Is that it?
To some extent. So because the technology and what it'll look like, how it'll be put on the ship, et cetera, is not quite figured out, we can do certain things to make our vessels, say, ammonia ready, without really knowing what ammonia fueling will look like in the future, what that infrastructure will look like. So it's kind of a step in the direction to set them up so that, 10, 15, 20 years down the road, when it's relevant, when it's available, we can make that transition.
It's like management with many future uncertainties to work for in solving this equation. Yeah. But maybe if we want to stay with this question of inflation and higher energy prices for a minute, I would give Detlev you the opportunity, or Amy, as I see you're with us still to comment on that. It's an important question. How do you see it, Detlev?
It's a very, very interesting to observe here, because in a way, higher energy prices should help to accelerate the transition. And if you remember back the discussion, political discussion in quite some countries, for example, here in Europe, has been, we need higher energy prices in order to incentivize saving of energy. We need it to incentivize switching to renewable energy concepts. Unfortunately, now in the current situation, energy prices have skyrocketed. And now, interestingly enough, the first reaction is also, well, let's protect our consumers from the too high energy prices. So I think we will have to live with quite some spread for the next couple of years, that energy prices might be high. They are also incentivized and probably accelerate the transition to renewable energies, which at the end should be cheaper. But I think in the meantime, we have to live with this uncertainty and with this complexity.
Indeed. And Detlef, why don't we stay with you here? And you know, when you mentioned the challenges that are created by inflation and energy prices, emerging and developing economies are particularly hard hit. And as we know, it's a very challenging time for capital flows to emerging economies in any case. And there was a big focus on this at COP with, you know, climate finance for emerging markets and so on. You know, also they face unique challenges in transitioning their transportation systems, which are already, you know, in many cases underdeveloped or need refurbishment. So how do you see this picture? Where are some of the most urgent needs and how do we finance them?
I think you pointed out rightly. If we look at the Europe or the US and the emerging markets, we have very different starting positions. In Europe and in the US, you have the situation that in a way we have to deal with an aging infrastructure. And if we look at it with an honest, objective view, over the last couple of years, there has been some negligence of refurbishments and maintenance because other priorities were set. So we have to, in a way, do the renewable part on the existing infrastructure. We have to do the transition into the new technologies, upgrade the energy grids and create the infrastructure. In emerging markets, we are missing infrastructure in the first place to deal with the growing populations, with the megacities, and with the increasing demand for transportation and mobility that comes with the development. So big capital needs have to be done. But I think there is an even more important problem. This also requires a lot of expertise in terms of doing these projects. So because you need the engineering talent, you need the companies who are doing this, the technology needs to be provided, and it needs to be all brought together. My personal point of view is, and it would be great to hear also Liz and Matt's view on this, that financing at the end will not be the bottleneck for this whole transition. The money is probably there. I think the question is, how can we get quickly enough, good enough projects, good projects with the right frame conditions so that an investor can see the business case and can put the money there.
Well, it's a age-old supply and demand problem, right? I mean, is it a question of a pipeline of bankable projects, or is it a question of, you know, having the capital to do it? And that's where this whole blended finance discussion really comes in as well. And I think we're going to see a lot of focus on that in 2023. But Liz, you know, let's talk about the capital markets angle to this. You're seeing greater receptiveness in capital markets for companies looking to finance more sustainable transportation, equipment, and operation? A lot of interest in this. How's it evolving, and what kind of innovations are you seeing in finance?
Yeah, I mean, the comments that Lev just made, I think the financial aspect and the capital availability is certainly not going to be the challenge. I think we've seen just tremendous demand from investors for things that are more ESG friendly. Matt can talk about this a little bit more, but we worked with the company last year on the first blue transition bond for the capital markets, and that was to finance some LNG vessels that they have under development. We've also worked with Norfolk Southern and Union Pacific on green bonds that they've done. I think Norfolk Southern was the first green bond really for the rail sector and really for transportation in the United States. And that was about 1.5 years ago. So I think we're just going to continue to see an increasing pace of companies that are looking to the capital markets to help address some of that energy transition and to really look to be thought leaders and help educate the market on some of what they're doing and some of the changes that are still to be made. We've also just seen a lot on the equity side. I think a lot of, you know, infrastructure investors now have ESG committees that they need to go to and looking at new projects or just trying to take a really thoughtful approach to how they can help in driving some of this investment, particularly on the infrastructure side. But like I think we've all been talking about, there's just a tremendous amount that needs to be done. And it's a question of how quickly, you know, that can really be rolled out. But certainly I don't think, you know, the financial aspect of that is going to be too scarce. I think at Wells, we've committed, I think it mentioned in the beginning, you know, 500 billion in sustainable finance by 2030. I think in 2021 alone, we deployed 68 billion, and 5 billion of that was for the transportation sector specifically. And I know we're not alone in doing some of that. And I think certainly there's a lot of outside investment too in the sector and in trying to figure out ways to, again, make transportation more sustainable over time.
Well, you raise a really good point around greater use of equity in these transactions. And I would just link that to some of the discussions at COP around these very high global debt levels. I mean, especially for emerging and developing economies, you know, the last thing they need is great piles of more debt to finance this shift to more sustainable models in transportation and so on. So it's an important consideration, the equity. But maybe can you give us a little bit more color, as it were, on some of these structures you mentioned? So you mentioned green bonds for the railroad industry and blue transition bonds. Can you say a little bit more about how those work?
Yeah, so it's a little bit different than what Matt was mentioning earlier on the sustainability linked transaction. So some of these blue and green bonds really are to set aside capital for investment into greener technologies. So it's not necessarily KPI linked. You don't get penalized, you know, if you're not hitting certain metrics, but really the focus of that investment and the dollars that you're raising there is to do more sustainable investment. And so it's a little bit different than some of the sustainability linked, you know, tools in the toolkit. I think all of these are just different pockets and different pieces that companies can use as they finance this energy transition. And like Matt mentioned, I mean, they've done in particular a lot of these different types of transactions. And I think all together it helps, you know, really drive a lot of what they're doing on the sustainability front. I mean, we've seen the same thing from the airlines as well. I think they not necessarily on the capital market side, but if you look at some of the investments that they're making, I know we talked about sustainable aviation fuel and some of the challenges there with availability, but they've started to make investments on their own into a lot of these facilities and looking to just increasingly commercialize the production of sustainable aviation fuel. We've also seen them make, you know, investments into eVTOL. What's the next technology? Because again, for aircraft, the technology doesn't really exist today that is, you know, totally clean. So I think it's going to be an evolution over time. And how do you meet some of those different metrics? I think Delta in their last earnings announcement mentioned that they were partnering with Airbus on researching and developing, you know, hydrogen powered engines, and what's the infrastructure again that's required around that, and how do we make sure that we have that in place when some of this new technology is available. So I think it's really interesting, the transition that's happening now. I think obviously there's a lot to do, but I think there are a lot of stakeholders all working really hard to see how to help affect that change and make sure that, you know, we can address some of these big challenges going forward.
Well, one more question from our audience is around this transition bonds in particular, this corner of the market, which is rather newer. Do you think this is a promising area? Do you think there's going to be a lot of demand for these transition bonds in particular?
Yeah, it's a great question. I'd love to get, you know, Matt's feedback on that as well. You know, we were able to do, and the reason we classified as a blue transition bond was obviously LNG isn't a totally clean fuel. It's not basically the final state, but it's a step in the right direction. And so I think, again, working with companies that have, you know, a little bit more of a challenge just in terms of how do you make that transition, because it can't happen just overnight. I think, you know, that transitionary language is helpful as you continue to just, you know, develop along that sustainability path and the sustainability, you know, journey that a lot of these different companies are on. But certainly I expect we expect to see a rise in some of that, just the same we expect to see a rise in a lot of these, you know, pure green financings or pure blue financings. I know the oceans in particular were a big focus at COP27 and some of the importance there and making sure we keep our oceans healthy.
Indeed, you know, that space in between what's green and what's brown, the transition area of increasing importance. But what do you think, Matt? Are you seeing this is a promising area, these transition bond structures?
Yeah, definitely. I think it was a great way for us to get eyes on our financings that don't typically look to shipping. shipping has a sort of niche investor base, while large. And this brought in a whole new kind of set of investors who are now well, entrenched in our name. And I think it's a good path for other companies in a similar position in transportation who are making that transition to get new eyes and to shift the conversation a little bit from maybe transportation generally is considered to be a dirty business, but to shift the conversation to it's one of the areas that the whole world needs to focus on, most importantly, to bring us to a much greener future. And we need to focus on the companies that are doing the right things to make that transition.
Yeah, and before I come to you with another question, Matt, Detlev, I wanted to give you a chance, if of interest, to comment on the role of the European taxonomy here, because we've been talking about, transition, what's green, what's brown. Europe has a very granular approach to this, which hasn't been the case in other jurisdictions. And at COP, one of the discussions was around, the efforts of Europe to kind of export its views on taxonomy. So do you see a lot of potential there for helping with issues like concerns about greenwashing and defining what's green and what's brown so that you can appropriately measure and track sustainable finance?
I think you can have a long debate always on if the taxonomy is exactly the right thing or not. What I would like to highlight here is I think it's helpful if we would have one single taxonomy that we would use globally, because that would make it so much easier to align on objectives, on standards, how we measure things, how we communicate, and what we are aiming for. So we will see which taxonomy will prevail, but putting a stick in the ground is certainly helpful, I guess, to get us moving collectively on whatever is the right taxonomy at the end of the day.
That's very, very diplomatic answer. Very, very difficult question, though. I mean, the G20 has also struggled with this concept of building a support for a single approach, at least to taxonomy. And again, I think interoperability is going to be where we end up at the end of the day. But as you say, that's another whole webinar on that topic. But Matt, let me come back to you just with a final question here. If you were to have your wish, what kind of changes would you like to see that would really accelerate environmental improvements in shipping and transportation?
Yeah, thanks. I think there's some of them are very difficult changes, maybe governments to align on their regulations. To a little bit of Detlev's point, if there's clarity universally across the system, that helps to set outcomes that we can all creatively kind of march toward. So that'd be one, but maybe a trickier one. The other is to my earlier point on investors being more discerning and the communication being more colored on transition names. So shift focus in terms of capital allocation, not just focused on what is ultimate green solution, but the people who are large emitters who are doing the right things to change the industry and putting the capital to work to transition. I think it's a more difficult area because it's less black and white. But I think second party opinion providers can be helpful there because they take the time with the company to understand the story, the targets, and opine on how green or how positive and relevant the financing is. And then I think I have seen investors make big strides in the last few years in taking the time to better understand the color behind that transition story. So seeing that kind of progress, I think will be helpful to funding the massive transition CapEx that's needed over the next 20, 30 years.
Well, it's a big discussion in financial regulatory circles, isn't it? I mean, channeling finance to things that are already green, is in some ways, as you say, an easier easier part of the equation than greening the brown. And yet those industries really need to be financed to make that transition. So how do you work that into a regulatory framework? It's another whole set of discussions. So thank you for raising that. This being a COP talk, I'd like to end with a few questions around COP per se, and invite folks to share their thoughts, on what's been happening at COP. There's been a lot of discussion around sustainable transportation and how to finance it. So looking across the whole COP spectrum, big though it is, where have you seen progress? Where are areas where more progress is needed, particularly in the areas of public urban transportation, sustainable fuels, and so on? Any thoughts? Detlef, do you want to take a crack at that?
Well, that's a tough one. I think it is important that politicians, industry, academic, investors are in deep conversation to exchange ideas, because at the end, I think to solve, I think the challenge that we all have in reaching net carbon zero can only be solved collectively, and it needs a lot of innovation. And I think we cannot highlight enough that innovation and new technology is the key that will enable us to reach our objectives. And therefore, if I had one wish as how this conversation will continue, is that we will put a lot of focus on how can we enable more and even faster innovation and adaptation of new technologies.
Indeed, and you saw a lot of that across all of the different country pavilions at COP. This discussion of the new innovations around things like smart cities, each and every one of them had some kind of key focus on transportation solutions. So that was encouraging. The other thing that was encouraging from our point of view that we saw was this emphasis on building like a collaborative ecosystem for financing that involved public and private and philanthropic sources of capital. So again, this blended finance discussion on how to make it happen. But Liz, did you have any thoughts on progress at COP?
Yeah, I think, Sonia, it's probably exactly what you just said. Some of the, the finance commitments by Western countries, I think obviously it's a large number. So it's nice to see some of that focus. And I think, the other interesting thing it seemed was just bringing the oil and gas, stakeholders back into the conversation, because obviously, as we've talked about a lot here, it's a transition. And so, helping to understand how that transition happens. And I think it needs everybody to be kind of pointed in the right direction and working together on that. So those were kind of my two takeaways on relatively important points.
No, absolutely. And it comes back as well to some of the remarks that Amy made earlier on the voluntary carbon markets. That was another theme that we saw quite a lot of, not only in the use of carbon credits and offsets and carbon credit markets to, offset emissions that are very hard to abate, but also in the flows that carbon markets can generate that can support emerging and developing economies and protect natural capital and biodiversity and so on. So all of those encouraging signs as these markets develop. So with that, we have come to the end of our time, and let me just thank all of you, Liz and Detlef and Matt and Amy for this really fascinating conversation today. Thank you for sharing your insights.